Hi everybody, welcome to the Attract Capital webinar series. Janine here with David Barnett, CEO of Attract Capital. Today we're going to be talking about the keys of raising growth debt for your fast-growing company. So Dave, it seems like this is an increasing topic across the market. So what do you have to say about growth debt?
Well, growth debt has really expanded. It's been around for probably 10 years, but as private debt funds have really accumulated more assets, they've really gone after. And this is for a specific type of company that has explosive growth potential, and it is growing in the market because lots of different funds are going after this particular application.
Great, so what exactly is growth debt?
So growth debt is when it's a loan to a rapidly growing, usually technology-based company that is where their revenue is growing very quickly, 25, 30, 40, 50% per year. They tend to be unprofitable, so they're not companies that are generating profits and can pay back the loan, but by the same token, they also have very large valuations because they're trailblazing companies, they're pioneers, they're using technology and going into consumer markets or going into business markets in a completely new way, and so they've got huge valuation. So like a good comp for people in our viewing audience would be like a company like Uber.
Okay.
Uber's been losing a lot of money, they lose billions of dollars, but they've been able to get debt along the way because they were so fast growing as they were kind of hitting their breakaway speed. So it's really debt for companies to accelerate their ramp up that have a technology-based angle to the business.
That makes sense. Will people see that there's other names for growth debt out there?
It sometimes gets confused with venture debt. Growth debt is usually more for companies that are later stage. Venture debt is usually for companies that are earlier stage. I'd say the commonality between the two of them is that they've got a big valuation, so the company is worth a lot of money, and there tends to be institutional backing, usually venture capitalists or other institutional backing into both companies, so that the lender feels that if push came to shove, the existing investors would be able to put more money into the company to increase its liquidity.
Okay, so with that push and shove, is there a certain criteria that attracts people to the growth debt and that process?
There absolutely is. So the criteria would be fast growth. It can be 25%, it could be 50%, but usually companies that have a land grab opportunity in front of them and they're first to the market, and by raising this growth debt, they can be first to the market with the most. They have strong intellectual property and they're technologically differentiated. They could be a tech-enabled service company. They could be an IP-based company. As I said earlier, strong equity sponsorship, and usually the money stays in the company and is used to amp up their commercialization, their expansion, their network, their people. Fast-growing companies need a lot of people, and they need them yesterday. This gives you the money to do it.
I like that, expansion. That's a very good word.
It's all about expansion. It's expansion of the company.
Yes. So what are the keys to bringing in growth debt, Dave?
The keys to bringing in growth debt, Janine.
Here we go.
The keys are, you want to have a very strong, multifaceted growth story. So you want to talk about the different ways that you can use that money to grow. You can grow your channel, you can grow your product set, you can grow your region, you can grow your organization, you can grow your capacity. You're probably doing some of all of those in your next phase of scaling up. So you want to talk about how multidimensional your growth story is and have a strong one. You also want to highlight how revolutionary the change is, how unique the change is. People, you get a big valuation, like let's say you're doing $10 million a year in revenue, but you might have a $100 million valuation. You only get that $100 million valuation if you're doing something seismic, something historic. So you really want to tell that story. What's truly unique about what you're doing that nobody else is doing or nobody else is thinking about? So that's the second. You also want to talk about how big the market is. If it's a truly differentiated product, but it has a market of $10 million, well, that's not that interesting. But if it has a market of $1 billion, that's interesting. So total addressable market size is important. You also want to understand, because it is a loan, ultimately they want to get their money back. So you want to look at when you're going to start making cash flow and when you're going to have to start paying the loan back. Because you may not be able to service the loan out of cash flow. You may need to bring in more loans, or you may need to bring in more equity investment in order to repay it. So you kind of want to make sure that there's a mismatch or an understanding of how you're going to pay off the loan. And the final thing is, you really want to show how you're going to become a dominant player in the market. Usually that means you have the best team, you have a great product person, you have a great salesperson, you have a great CEO, you have a great chief technology officer. So it's the caliber of the senior management team and their prior experiences that give people the confidence that you can take their growth debt capital and put it to good use.
Teamwork makes the dream work.
There you go.
Dream team right here.
Teamwork makes the dream work. The dream team, including the camera person.
Yes. So there you have it. Keys to raising growth with your growing company. And thank you, Dave, for sharing all your insight.
Thank you,
and we will
Janine.
talk to you all soon.
Take care, everybody.